Fed Bullard once again is giving the markets stage fright to continue the rally. Quote, the Fed needs to get to 5 to 7% Fed funds and hold those rates through 2023 into 2024. That is what has caused a lot of these violent moves back and forth today. And it's far from over, guys. And why that is so important in particular, well, there's a couple reasons. And I want to break it down to you guys right now if you have a minute. And if you do have a minute, and if you like the information and perspective provided to you here in this video, make sure to hit that like button and subscribe to the channel. Absolutely free 99 to do. But enough of that. Why this is so important and why it's sending the markets down about 1% today, or at least helping to move the markets down 1%, is because the markets are expecting the terminal rate, the rate in which the Fed will raise rates to and then stop raising rates and eventually cut rates from, is 5 to 5.25%. If Fed Bullard is saying he expects rates to at least go to 5%, if not 7%, well, that's way out of the market's realms of pricing in. The markets are not pricing in over 5.25%. You would see that reflected in valuations. I mean, the S&P 500 would not be sitting close to $400 if you were expecting over 5% or 5.25% Fed funds rate. And why that's so important, not only just for downside in the stock market getting a higher terminal rate, is because Fed Bullard said through 2023. And the markets still are expecting at least 1 to 2 rate cuts by the end of 2023. And it looks like that's certainly not Fed Bullard's projections. That's certainly not what he thinks is going to happen. And he's been pretty spot on. He's been a pretty, hawkish member of the Fed for the last year. And what he's basically said is almost always came to fruition. So I think that is very important. And on the other hand of that, if the federal funds rate even stays at 5% through 2023 into, let's call it, the first half of 2024, you will see a recession. There's no way around that. The markets have been so used to, I'll just call it, the funny money, interest rates being so cheap, you almost get paid to take out loans, factoring in the rate of inflation, right? Well, the markets are not used to the rates that we are currently seeing. So real estate, yeah, consider that market goodbye. Stock market, that's going to take a couple years. It would be pretty bad across the board. Not only are you seeing the crypto infestation that continues to grow, and we'll talk about that with BlockFi just declaring bankruptcy, joining FTX, Celsius, and a couple other firms in bankruptcy proceedings as well. Nonetheless, if you're talking a 6 to 7% federal, terminal funds rate, well, you're talking a pretty deep recession at that point. And the longer we have to stay there, the worse off it is going to be. Fed Bullard also expects below trend growth for 2023, which he expects the U.S. economy to avoid a recession. And obviously, if he expects the federal funds rate to stay in between 5 and 7% throughout 2023, he does not expect a recession because recessions induce deflation. And when you get deflation, the Fed always cuts rates, right? When deflation comes, when a recession comes, the Fed cuts rates. You don't continue to see inflation. So I guess take that as you will. The markets are going to freak out and sell off more based off of a recession than the Fed actually raising rates. At least that is what we have seen. With history, the Fed, once they start cutting rates, that's historically when it's been a good time to get out of the markets, believe it or not. During tightening cycles, the markets tend to react very positively. And as you guys can see right here by this chart, it's literally just how it goes every time. 1960s, Fed was raising rates, right? Markets were rallying, you get a recession, the Fed cuts rates, that would have been the time to get out the markets. Same thing in the 70s, right? Markets were booming from the early 70s, and then you get into the mid 70s, and inflation was still really, really high, and then it ultimately came down. I think that's one exception to the rule. Well, look at recent history, more recent history, 1980s, right? The Fed was raising rates, they start cutting rates, recession comes, they really cut rates. Time was probably to get out the markets. Same thing back here in the 99-2000 tech bubble. Fed was raising rates the whole time the markets were going parabolic. They started to, hold rates steady for a while, and then they started to cut rates. Recession came. That was your time to get the F out of the markets. Same thing during, 04 to 07. That was a very good time to be invested in the markets. And what the Fed do consistently raise rates the whole time. You cut rates because a recession comes, and boom, that was definitely the time to get out the markets. Even back here from 2014 through 2019, right? Then you had the COVID crash. Obviously, that's a good lesson to hold your stocks and not sell them, because you would have missed out on a very big rally at that point. But look what we're heading into. Fed's aggressively been raising rates at the steepest curve that we have in a very long time, and the markets have been going down a lot. So it just makes you wonder, when that recession comes, how bad that downside could actually be. I think it will depend on how deep or how widespread the recession is actually going to be. That's pretty much, though, what has caused the downside in the markets today. A couple other things would include the protests that you have seen, or riots, whatever you want to call them, in China. And this has a lot of implications, because maybe the Chinese government changes their policy on the zero COVID policy, and that would probably be a bullish thing for the markets. Chinese stocks were down well over 2% because of these protests, but maybe it could shake up some things in the government as well, and that might be seen as a positive thing, but there's always room for that to turn into a negative thing. But it's uncertainty, and the markets don't like uncertainty. The markets actually hate uncertainty more than they hate bad news, because you just don't know what is going to happen. Now, a big story that is also developing here today, and this is the top headline on CNBC, it is that BlockFi goes bankrupt following FTX, and it says crypto firm BlockFi files for bankruptcy as FTX fallout spreads. And now it's BlockFi, FTX, Voyager Digital, and Celsius. Who knows who is next? Literally, the king of the hill, you guys remember that game as kids, could just be Coinbase, and everyone else might be doomed. Now, the issue with this crypto situation is not crypto itself, not the actual coins and who loses money. A lot of people weren't putting money that they absolutely needed into these coins. They were more speculative trading vehicles. So at the worst comes the worst, a lot of people investing in these coins, were willing to take these losses. Not so certain on, if people were willing to lose what they had in these trading platforms. But at this point, if you still had money in them, that was a obvious no-go for a long time. But the real problem is contagion. And as you can see, the company listed an outstanding $275 million loan to FTX US, and it also shows that the largest customer of BlockFi had a balance of nearly $28 million, which is wild to even see, because you must have been pretty loaded to have $28 million in BlockFi with all of the she's hitting the fan. Can I say shit? Am I gonna get shadow banned? The shit hitting the fan in the crypto market. So I think that is pretty astonishing, and you just don't know how far this contagion goes. The first domino has started to fall already, and you're seeing the other dominoes falling. Once you get to a point where so much money has been lost, who is that money owed to? Is it the billionaires? Is it the banks? Is it private lenders? Is it, companies? You just simply don't know who is owed all of these billions of dollars that is losing this money, or how that could impact the market. So I think this is something that, will continue to take months to play out. But once you're said and done, I think there might be an actual credit crisis or some kind of liquidity crisis that does come out of all of this, guys. And like you can see, it's the main headline over on CNBC. Now, switching to the charts a little bit, we're taking a look at TLT, and it is slightly positive on the day, up 0.05%. So I would call it a neutral factor on the day. When this is positive, it's a beneficial thing for the markets. As you can see, it's corroborated with the drops and the pops in the stock market. When this chart goes up, bond yields are going down. When this chart goes down, bond yields are going up. So when this chart is going up, bond yields are going down, and that is a good thing. So it's a pretty neutral day today, not really making a big move up. Bonds are not doing a lot. But if you take a look at the dollar, same thing, but to the opposite effect. When this chart goes up, it's negative for the markets. When this chart goes down, it's positive for the markets. And today, the chart is up. Today, you are up about 0.5% with the dollar. You can track this by using UUP on your trading platforms, and it's tracking the dollar relative to other currencies. Some people win with the dollar, but most people lose with the dollar, especially your conversion ratios. And that's where a lot of you guys, if you actually read conference calls or listen to them, a lot of companies talked about constant currency and what that effect had, and that is because the dollar has been going up. So on a constant currency basis, earnings would have been XYZ. They would have been a lot better, right? So it fundamentally hurts companies, and when this goes up on a day-to-day basis, it tends to cause bearishness in the markets, and you are firmly seeing the dollar up about 0.5%, which is a pretty big move for the dollar. Now, if we take a look at the S&P 500, pull this up to the daily candlestick chart, I have the same patterns drawn up, the same moving averages, and it does look like we firmly got rejected around that $200 or $402 level on the S&P, which is the 200-day moving average. Now we are in between this channel, guys, and the big thing I want to see is if we do come down, if we break under this ascending level of support, then that's where you could get a lot more downside, and that break would likely occur around the 100-day moving average at about 390. So depending how the next couple of days play out, that could be potentially a lot of pain for the stock market unless Fed Jerome Powell comes out and shocks us with something dovish. It's not looking very bullish from here, and if you break out to the downside under this trend line, your next level is going to be the 50-day moving average, again back here at 378.51. And a big problem with this rally is valuation, especially if rates stay higher for longer. The stock market is overvalued where it's currently sitting at with the indexes, not with individual stocks. I think it's a great time to buy individual stocks for the mid to longer term, but on an index fund kind of basis, it's a terrible time to be buying stocks, guys. So that is going to be it for this video. We covered a lot of ground. Hit the like button and subscribe to the channel, especially if you made it to the end of this video. Thank you for watching, and I will see you in the next one.